Good morning, Roland. How are you?
Good morning, Raheem. I'm well. Yourself?
Good, good. Last time we did this was in January, and it feels like it was yesterday, pretty much a blur. How have things been with you, your end?
Yeah, no, it's been busy. I mean, obviously this time of year, RSP's taxes, it's busy for us, but we see the light at the end of the tunnel here. So it's
Perfect.
good. It's good.
Awesome. So let's get to it. We want to make these videos as short and sweet as possible. We do have a lot to cover. So we'll do Q1, we'll do a little wrap up. We'll obviously talk about the banking crisis. It's top of mind for everyone and some of the impacts for that. And then, as we always do, we want to talk a little bit about, how to make things a bit more positive. So we'll look at what's been going on with inflation and rates, and then that will be it for the recording. So talk to us about markets in Q1. So the chart that I've done here, essentially, it focuses, I'm going to move our video here. So this chart focuses on the US market, but I'll let you tell the story of what's been shining once again in Q1.
Yeah, so this is a classic, this is a classic sort of a rebound for assets that were oversold. And so, for example, you had the blue line, you have the QQQ, which is basically the Nasdaq, and the Nasdaq did really well for the last decade, and then obviously last year in 2022 it sold off hard. And so usually when you have a big sell-off like that, you tend to have a sharper rebound, right? So that's kind of what you're seeing in the first quarter here. Nasdaq is sort of the growth index, and so it's rebounding harder because it's coming from a lower base. And then on the opposite side, you have the value index, which is the orange. It held up very nice last year, right? It did quite well, relatively speaking. And so because it did well, and it held, it's not rebounding, right? Because there's not much to rebound from. And so the green line, which is the S&P 500, kind of a mix of the two, sort of just shows you, which is well, it's the market when we refer to the market. The green line sort of just shows you, it's in between, because it makes sense, right? So obviously when something is a component of the two, you get the average. So it's a bit of an average. Then the market, listen, it had a really strong January, not so a bad February, and a slightly bullish March. But that's really just based on some of these interest rate plots that the Federal Reserve has sort of projected out, right? So like obviously you had the banking crisis, which they didn't account for, right? So 3-4 months ago that wasn't on their horizon, and so it impacted the rate path, so to speak. So you see some of that play out in the markets here. There's also some seasonality going on here, right? So typically markets tend to have a strong January. So you're sort of seeing the effects.
Perfect. So as you said, a little bit of reversion to mean, based on what we did last year. And would you say a little bit of with the Nasdaq being so heavily reliant on Apple, Microsoft, Facebook, Nvidia, kind of that safety trade with all that's going on in the market, it could be that people are buying businesses with their high cash balances and not much of a reliance on the bank. So a little bit of that. But overall, for the average person who's in the S&P 500, last year, you didn't get destroyed vis-a-vis what the Nasdaq did. And this year, same thing. So little bit of a smoother ride, but overall a decent start to the market versus what we saw last year. So you mentioned, kind of rates stabilizing a bit and forward looking, maybe even pricing in steady rates, maybe not so much of an increase. We saw Canada didn't raise, US raised a bit. I'm not going to spend too much time here, but it's nice to see that the bond market also is rebounding back. So year to date, for the FTSE Canadian Universe Bond Index, up 3%. The corporate bond index overall 2.6, and the high yield up 2. So if you are a balanced investor, you've made a little bit of money in Q1 of 2023. Talk to us a little bit about, you mentioned the banking crisis, right? So this chart kind of shows all of the bank failures in recent US history. There's been a bunch of them, but the one we're focusing on obviously is 2023. So maybe just for 30 seconds, tell us what led to the crisis and what we're looking at here.
Yeah, so basically, so first, Silicon Valley looks large there, number two, because ultimately there's more money in the system, right? So anytime you have these type of stats, as time goes on and there's always more money, there's always going to be a bank that looks like it's really great. But from a relative perspective, it's probably not a number two, right? But quickly, basically they are a regional bank that's customer base is just very heavily employed in the tech sector.
Right.
So if you're a bank, that's sort of a red flag right there, because you basically go as the tech sector's needs go, right? And so with rates going up, that's the growth sector. It was out of favor, and so ultimately, of course, it didn't help that they mismanaged, right? So
their long-term treasuries versus what the interest rates are, right?
Exactly. So there's a perfect storm, an element of mismanagement, the environment. But what's I think is the most troubling and interesting is the bank went from quote unquote healthy to liquidation in literally days.
Yeah.
And I think that's something that the Federal Reserve is really paying attention to. Like, okay, so how safe are these banks really? And
yeah, so essentially, when investors found out that the bank wasn't healthy, when they had to mark the market, there was a run on the bank, and the insane statistic that I heard is 90% of their deposits were not insured. So 90% of their deposits over 250K. So obviously investors felt very uneasy. Twitter went nuts over the weekend. People started pulling their money out, and essentially the bank went under. But you mentioned, this chart, Silicon Valley and Signature look high on the list because these are bank failures. But to your point, if we look at the big banks, Silicon Valley and First Republic are I wouldn't say systemically as important as the banks that you see up top: JP Morgan, Bank of America, Citibank. So, they, as you said, very, very heavily leveraged or tied to the tech sector. And as that sector was deeply impacted last year, investors needed to pull their money, and so went these two banks. But overall, we looked at the markets. This happened in mid-February. The markets held up pretty strong. So we're working under the assumption that the markets are not too concerned, that these are widespread instances and more local. So I think your point is well made. These are relatively small in the grand scheme of things, and as far as we could tell, nothing for investors to worry about. I thought this chart was pretty fascinating, and I'm not sure exactly where this is a rate story. Did the Silicon Valley Bank crisis kind of pay more attention to it? But this chart essentially shows money market deposits skyrocketing versus deposits in commercial banks. So are you, as a portfolio manager, are you seeing a lot of investors take money out of banks and buy more money market instruments? Is that happening in your world as well?
It's happening in our world, but it hasn't happened a lot, right? So percentage basis, we've had very little of that activity. You're looking at that graph as an aggregate. So the bank's failure, as you see February there, it spiked, which sort of makes sense. But I expect that to sort of normalize. But yeah, it's happening. But it's ultimately it's all a lot of it also ties to policy and insurance, and it remains to be seen if some of these deposit insurance rates will change. But I think clients are just sort of more awake to the idea of, hey, maybe I should have my assets sprinkled around. Maybe I should be
Yeah.
made smarter about how do I have my assets held so that they are insured, because clearly some of the banks are not
And
insured.
if you move money out of your checking account, let's say, this is a function of the blue and the red that you see here. If people are moving money out of their bank accounts and they're moving it into money market, now they're earning a yield as well. So as rates are relatively high versus historical ratios, maybe it's not it's a smart thing for the investor to actually make some money risk-free, so to speak, in the money market vis-a-vis pulling money out of their bank deposits. So I thought that was a pretty interesting chart. Inflation here, as we could see, regardless of what inflation measure you're looking at, whether it's core CPI or PCE, I think what I would focus on, some of the good news is that it is trending down, not where the federal governments would like it, but nonetheless trending down. And the positive that I would take from this, and correct me if I'm wrong, is if inflation goes down, then the rates can come back down as well, and then the markets can normalize. So is that what you would take this as well, in terms of what you see here?
100%. So really here, what I would focus on is like also the rate of change, right? So you're right, inflation is going down from last year, but it's still higher from 2 years ago, right? So
Right.
if you look at 21, you came from basically 2% or nothing,
Yeah.
and then it shoots up. So obviously it shocks the system, but now it's sort of easing up and normalizing. So even if it's just a slow bleed down,
We'll take it.
that's okay, as long as you don't have this huge shock to the upside.
Yeah, and I like this chart. This one's from Morningstar as well. It shows core CPI X shelter. So we know shelter is stubborn. It takes a while for that number to come down as people put less emphasis on the value of their homes. Shelter, X shelter, the numbers look pretty strong. There's a little bit of a tick up, but it looks like that's what's keeping the overall number high. And hopefully once that comes down, month over month, CPI numbers look pretty good from a perspective of them going down. Wage growth is the other thing. So wage growth is no longer growing, which I guess is good news, bad news, because if that's less pressure on employers to pay employees more money. And if wage growth is not going through the roof, we are not spending as much. And if we're not spending as much, there's not a upward pressure on inflation. So I think this chart, it just goes and ties into that CPI number. But your thoughts on this chart? So this is a chart of what the rates are today and where Morningstar thinks they're going versus where the Fed thinks they're going. What are your thoughts on this chart?
Yeah, so I watched this. The Federal Reserve publishes their path.
Dot plot. What is it called?
Yeah, that's exactly dot plot. And so, they're in their view, okay, fine. In 23, we're probably going to go a little higher, once or twice more, and then the next couple of years, it's going to go down. So that's sort of where they're standing as of today. Now they don't really know because there's so many factors at play that they cannot predict. But I think what you can take away from this chart is, for what it's worth, Morningstar forecast, I'm not sure how accurate that would be.
Yeah. Of course, that's a house view.
Right, but their view is that it's going to go down, right? And then if you look at the Fed projections, they're telling you that it's going to go down. Only the future markets are telling you that it's going to come down, but it will sort of normalize, right? So if you look at the purple dots, the futures market's pricing in mid 24, so just over a year from now, they're saying it's going to stop at 3%, just below 3%.
And correct me if I'm wrong, the futures market is actually implying cuts, right? Based on what they're thinking versus where the Fed is. So they're thinking possibly cuts later this year, and overall, more of a normal rate. So the market is somewhere in between Morningstar and the Fed. I like the market's view versus just any one house, but again, we talk about the we want to end things off on a positive note. These rates are hopefully not the norm, right? The norm is not going to be 5%. The norm is going to be less, but inflation needs to do its thing. It needs to come down, and then the Feds can take their foot off the pedal, so to speak.
That's right. That's accurate.
Perfect. So thank you, Roland. I think we covered a lot. A little bit of a bounce back in the markets, mostly due to tech. Silicon Valley Bank situation, hopefully contained, so to speak, not very, very widespread. Inflation, to wrap a bow on it, it's not going up. That's the good news. Stubbornly still high, but hopefully on its way down. And we'll do this again and hopefully continue to have some good news for people that listen to this in Q2.
Perfect. Looking forward to it.
Thank you for joining, Roland.
My pleasure. Thank you. That was good.
Yeah, I'm still recording. Okay, there it is.
I like